Hey, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Monday the 5th. I think we've got two more of these after today, and then we'll take 2 weeks off or 3 weeks off. I'm not sure. But hopefully Keith took care of you last week, and I'm kind of excited. I'm just going to make some comments, and we're going to look at a couple things just to see what's going on. So last Monday, I'm on everything. Last Monday, Keith said we were mostly unprotected. Reason why? Christmas rally. Stocks were heading up with Fed comments from Powell that they would slow down and less basis points. Just meaning that instead of doing 0.75%, they might only do 50, right? So the market's like, hey, things are going to slow down and we're going to keep going at a better opportunity. But the reality is the rates are already up there, right? The better opportunity is if they were to reduce rates to make getting cash and borrowing easier. So let's face it, the reality is the market is forward looking and looking forward that things will be easier in the future than they are today. Easier than the shocks that the Fed has totally overshot their mark. And it's just like, for crying out loud, you guys are killing the economy. So that's where we were at last Monday. And a couple people were like, so let's talk about Disney. So a couple people are, why protecting Disney around $98? And I just got two comments that came in. And and so the two comments, I hate your Fed on the other side of the pond, and the Fed that's their mandate to always get it wrong. I love it. Why are you protecting Disney around 98? And I'm just going to go to a chart because that's the easiest way to look at it. And I'm going to bring it out to basically a year. And I want to show you Disney. And the short answer, Disney was having a hard time getting over 100. It was a support level, and then it became resistance and resistance. And we broke through resistance, ran up on some good news, came right back down, resistance, 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 and it starts to finally coincide with the 50-day simple moving average. So, got it, Jim. So, one of the big things is that Disney, we were not seeing the ability to break or to stay above 100. Now, we haven't exactly got Disney protected right at 100. So we've been protecting it twice around 98. And we also have cash, got to type right, cash available for more shares. but we decided we were holding off. Kevin, what made you decide to hold off? Well, it comes right down to our S&P 500 chart. We have been holding off for a lot of November due to the run. And really, right here where we gapped up, getting above that 50-day, we were using the market as a signal or an indicator to let some things run. Well, Kevin, why didn't you do it down in October? Well, we were not using it as an indicator there because we were protecting individual stocks through earnings. And to be honest with you, we had our double bottom, but it was staggered, and we went below the lows of September. So again, pretty technical analysis here on what we were looking at. And we were protecting individual stocks at that time, not necessarily the SPYs or the market. So we weren't as confident in the stocks moving higher like we were in November. Some of you are making comments. Kevin, it freaks me out. You've got no protection. After earnings and during a bullish market, this is what we're looking for to make those decisions. It's not that we're just randomly saying, whatever. But can anyone see what's happened today? If you were to look right here, for those of you that have had some education in the market, what can you tell me is happening today on the S&P 500? Russ and Todd, nice to see you guys here. You joined a little later. Jim Bosserman, good to see you here. Tob, it might be Tob. I don't know if Todd or Tob. Nice to see you. Dave and David, you guys came in. So there you go. I can always count on Mary and Maud. Pull back at resistance, breaking support at the 200-day. Correct. One of the main moving averages, that 200-day, the S&P before hit it, and we went all the way down to the lows. That is our most recent. You can go back to June and see much the same thing. But we hit it. And I'm going to go ahead and I'm going to do this one more time. We hit it, stayed above it for a day, tested it for a day, tested for a day, and on the fourth day, we broke down below. Tomorrow will be a big day. And tomorrow, if we head down, we will probably head all the way down to the 38.18. We did not hold 4,000 today. We closed below 4,000. 1.79. I actually thought I saw it at 1.81. I wrote that down. So a couple of you are like, oh my gosh, are we just getting killed? And I enjoy getting to be able to show you this or make these comments. I guess it's not a comment. I enjoy being able to show you as a whole, as we look at it, for the big stuff, we were down $51,929.13. And this is kind of you guys, right? This is where you guys are at. The market was down negative 1.79, and we were down 0.4 as a whole. So that's just how we kind of judge in general if we're okay. Now, we also have a second group much the same positions, and I'm bringing it up but hiding it from you. And actually on that group, we were down 0.52 on $10,451,000 there. Notice quite a bit of cash. We are cash heavy. We are 22% in cash. Even after adding some positions a couple weeks ago, we have decided to hold on to some of that cash to make a, I don't know, I don't want to call it a smarter or a more educated decision on where we're at. But it just, for us, it seemed like we had to be, we wanted to be smart in our decision. We wanted to be making the correct choices. And if we look at your guys' stuff, 2.9, so out of 15, we're at about a 19% cash holding, where we still have cash in a lot of accounts to put to work. We're judging what we're going to do based off of the market as a whole. One of our biggest concerns coming into the future December 14th, rate hike verbiage, right? What is he going to say? Can we go higher if they're going to slow down, if we have something to look forward to? And in all honesty, a Christmas rally will start in that on that day if we're going to have one. So it would start on the 15th and it would end on January 6th. We would have a 3-week Christmas rally pending the comments made by Powell. And so that's where we're sitting there and looking at things. Okay, I had a couple more here. Baidu. We were asked, why are we in Baidu? And I think I've told you a bunch of times, hey, second biggest economy. It has its hands in 7 different areas, or its fingers in 7 different areas, multiple parts of the pie. I don't think we have bought into Baidu, but I don't exactly remember. What I do want to point out, though, is we did a really good job of protecting. And one of the reasons we're in Baidu is because we've had a run from 73 all the way up to 116. Baidu has been one of our big winners year to date over the last 6 weeks. So if we have Baidu in your account, we're loving it. Our line in the sand for adding more shares was the 200-day, and we're really looking at about 132. Well, Kevin, we missed from 75 up to 132. Yep, we get it. Our goal is not to throw good money at bad. We were never intending to make up every penny on the way down, but we made up a ton of money on the way down. As for adding shares, we were looking for a bounce. We almost did it at 99, but we chose to wait until it has a stronger level of support, and the 50-day has not been support for Baidu at all. Going back to Disney, our adding more shares of Disney sits at over 100. We've we've struggled because we haven't added shares on Disney. God, I'm pretty sure it was 135, and it was back in April. But we're waiting until we're convinced that Disney can hold the 100 before we're adding more shares. And even though we could add 200 or 300 more shares to accounts, we're probably just going to add 100. We're going to be smart versus randomly just throwing shares into accounts. That's not what we're looking for. There's more to it. And last but not least, some of you said Under Armour. Oh my gosh, Kevin. What are you thinking? Well, it is somewhat easy to say. Under Armour and the opportunity is up at $27.28. We've got a great opportunity to add some more shares. We added some more shares down below closer to $7. Our key for Under Armour is going to be really when we just added shares, boy, not too long ago either. I had shared a couple times here. But our trigger again is the 200 day. Up at 11, and some more shares. Kevin, Under Armour, really? Well, if you go from the lows, it was down at 649, 638. It actually closed at 665. We've had about a 50% run on the price from the closing lows of 665 up to where it's at. And we now have protection at $10. Kevin, explain that to me. Well, the low closing price was $6.65. If you multiply that by itself, which is a 1, plus a 50% increase in the price, you will get a number of, and I want a calculator so I get it exact, even though I've just done it 3 or 4 times today. 665 closing price times itself and a 50% increase. The number is $9.97.5. It was shocking because a couple of you talked to us and you said, man, we just want to get out of Baidu. Not Baidu, excuse me. We want to get out of Under Armour. And since that time, we've had a 50% run on the stock. Just because things go on sale doesn't mean you run out of the house or run out of the store and basically give up that opportunity that we have. 50% upside from the closing lows of $6.65. Okay, so interesting article was brought up to me. Kevin, banks, my goodness. What are your guys' thought on banks? I want you to give me your 2 cents. If you're thinking about banks, good investment, bad investment, give me your thought processes on banks. I'd rather be in an American bank than an overseas bank. William, God love you. I think the Federal Scare one says to spend less on the holidays. That was a previous comment. Very interesting observation. I think good as they have to improve things after the financial crisis of 2008. I would like to own one. Banking should be on stable footing with stress tests. Bill, any comment? I'm kind of looking for a comment from Bill. Banks seem like they should do better with higher interest rates. Yes, because they can make more on home loans and commercial loans, home equity loans. They make more on credit cards. It also widens the spread so they can cheat more in the spread of loans and so forth. No comment from Bill, huh? All right. It's interesting because I read this article a couple times. It was brought to my attention. Banks are short more than $1 trillion in capital. Bill, I asked what you thought about banks. Own it, not own it, get away from them. Anyway, this article is introduced to me, and this is where we try to have you guys do some of your thinking on your own, right? Mathematically, banks don't work market to market on the value of their assets. And mathematically, the banks are short 1.23 trillion if they were market to market on their assets on their balance sheet. So if you heard that, what would your thought process be on banks? There you go. Good answer. I love it. Bill just said, I don't think about them. The numbers are figured differently. Correct. So what are your thoughts on banks? There you go. It would scare me. I'd probably want to get out. I agree with your position, but for personal reasons, I prefer to use credit unions. Actually, I'd use credit unions too, Jim. Good answer. It looks like banks are in trouble again. Okay, so it's funny because I'm going to use, for this purpose, I'm going to use I'm going to use homes, right? Your home value fluctuates all the time. But for most of us, we're in a fixed 30-year, 20-year mortgage. And because of that, the banks are getting paid. They're making their interest in that first 5 to 7 years to make majority of the interest in the loan. It's not a simple interest loan, of course. And for all intents and purposes, let's face it, they're getting paid. So to go market to market and to say that banks have a shortfall of 1.3 trillion is not understanding some accounting. It's not understanding how banks run and make their money. It's really not a good understanding of our banking system as a whole. Not every loan is a home equity line of credit. Not every home is a floating rate of how do I say it? It's not like it's a floating rate of interest. If you, as I made the comment, I think I called the guy an idiot, but an educated writer trying to make a name for himself. Because, and I went and by the way of their funds, you know, funds market to market are in banks' favors. If they do a bond fund, they get their money up front of $1,000. If the bonds come crashing down, they'll buy them back for pennies on the dollar. They'll make their money and profit, the fees, it's all theirs. For the next 10 years, the banks are going to do really good on their funds, mutual funds, bond funds, because they're not market to market or dollar for dollar on current pricing. So here we have this big article that may be the reason why Bank of America is back down to $34 and change. Pretty neat that we still have our protection up on it at 37 or 38. I can't remember where it's at. But we've done a great job of making sure that when we saw a previous high, we had it protected. So please be careful what you're reading, because not all banks are created equal. Not all articles have the big picture or to understand this. And someone just typed in, "Good job, Keeve." Yeah, so for those of you who didn't know, Keeve was filling in for me as I spent a lot of time down with my father in Houston last week at the MD Anderson Cancer Institute. But just because you read some of these articles, I would strongly suggest you spend your own time working your own numbers and understanding what it means. Higher interest rates, bigger spreads, more profits. For previous bond funds or mutual funds or fund funds, it's all to their benefit. So as horrible as this article looks, as scary as it looks, as banks are not the place to be, it's another buying opportunity for us to make money on the way down and to pick more money as things head back up. Are there any questions in general on maybe how accounts are being run or what we've looked at, as well as what we're looking at here in the future? Let me just see if you guys have any questions. We'll do the best we can to answer them as they come in. So Kevin, do you think we're going to have a Christmas rally? And again, I think I made the comment 2 weeks ago, ask me after the December 14th rate hike. As I showed you, we'll have it from the 15th, which is a Thursday, till a Friday, January 6th of 2023. And if you think we're going to have a Christmas rally, you're going to have to give a lot of credit to Jerome Powell. Personally, I'm probably 49% Christmas rally, 51% no Christmas rally, because right now I've got a really hard time giving Jerome Powell any credit, period. I think he overshoots. I think he's not necessarily qualified. Of course, I go against Volcker and Greenspan. Those are my heroes in the FOMC. So very interesting comment. Again, I'm probably leaning more towards no Christmas rally right now because I'm not giving Jerome Powell the credit maybe he deserves to be managing our financial crisis and inflation right now. Does that answer your question there, Dave? What happened to Square today? Down 7.39%. I haven't figured that one out either, other than the fact that you could be at a retracement for Square. I was looking for news on Square. In fact, really, I was looking for news on everything. Visa was down 1.83. Banks in general were down today, with JP Morgan down 3.19 or 2.8%. Key Corp down 5.93%. Bank of America, again, took a pretty good hit today, 4.46%. When I looked at Square, it kind of runs in that PayPal category. There was no specific news to Square other than the fact that Square is a small business. It's a small business type of finance instrument, right? Like Venmo and PayPal. I think the market's getting wind that we're still going to have interest rates. which hurts the small guys. I mean, it hurts me. I was complaining today for Kiev on our office rent we had to pay. It's like, can you believe we're paying, we're going to pay $4,000, $4,200 for a year on something we visit once a month? Kind of seems like a waste of money to me. Not sure, Russ, but we did see a little bit of rebound after the market closed. As a general question, how do you set a line in the sand in the case markets get really bad? Would you manage it gradually or act only once? So in all honesty, Abraham, we manage it on a per stock basis, and then we start to manage it on support and resistance levels as well as SPY support and resistance levels. If it got really bad, though, we would just double up. We did really good on Baidu. Boy, from 160 down to, Keith, correct me, was it 120 or 100? 105. I mean, 160 to 105. We ran double the puts and made more money on Baidu falling from 160 to 105. So, again, we just use support and resistance levels. We just use what we learned in 2008 and apply it to big market crashes. We've had some crashes this year, but it's really some singular months. And I'll be the first one to tell you, if you were to look at us, first quarter, Hurley Investments sucked. The transfer to Schwab was awful. It was amazing how hard it was to get things over, to get approvals for options. It was like we were at the market's mercy. Really, we say the first quarter, but I'm going to run off through April. It just wasn't good. June, to say it simple, tough month. Hard to read. I want to say as well, we matched the market during that time. That was pretty good because we had some stocks that lost 20-25% in that time period. But June was tough. It was a hard read. We weren't the best at it. And then I could say September on to now, we kicked butt. Nothing like seeing September be a 9.8 down month. As a whole, we were just under 4%. For lack of a better term or answer, our transfer was horrific for Hurley Investments. We left 15% of the business over there. It was really cumbersome and hard for you guys to get access to it and to get things on. Schwab is a stickler. We had, due to our 13, 14 year, is it 14, 16, 16 year history over at E-Trade, and they bought out some other ones. The short answer is, due to our history, we were allowed some leniency in areas that we were not allowed in Schwab. In fact, Schwab doesn't allow short puts in any retirement type accounts where we could use them in the past to help lessen the cost on insurance for trusts and for IRAs and Roths, for 401ks, for SEP IRAs. And these guys are, well, Kevin, if you didn't have the long side, it means it's a synthetic short position. It's like, well, we're not going to not have the long side. We understand that. We wouldn't do a naked short or a synthetic short. What is your problem? Well, mistakes can happen, and per FINRA's rules, we don't have to allow it, so we don't allow it. Man, I've scratched my head and thought, you've got to be kidding me. Not only do you guys not understand it, but you're not allowing it because you're assuming we're going to do something wrong. It just was shocking to see how the transfer came over. But I feel we've righted the ship, and we're still to low with cash heavy money in the accounts to pick up more shares. And we already have picked up more shares both in March and April, a little bit in June, and we just recently did another share ad. So hopefully that answers a really long-winded question on what would we do if things got bad and what's happened, this year, so to speak. Okay, let's kind of cruise on through. We've got Costco reporting, rather interesting. I will be paying attention to that. The big picture, really not much has been in, but we're already talking about 2023. And so here is the question. Are we going to be in a recession in 2023? And I just scratched my head, and I'm going to say it as politely as I can. How stupid are our economists or our politicians today? And I don't care if you're Republican or Democrat, or you can be any of them. I just think they're all equally stupid right now. Equally stupid and then some, right? Q1, January through March. Q2, April through June. GDP, 2 negative numbers. I just am scratching my head. Laugh at me when I say this. What the hell is a recession in economic terms? Was a recession? Recession is a slowdown or contraction of the economy over a business cycle. The period of time and exactly what indicates an economic recession are not tightly defined. Huh. What does a recession mean in 2022? I love this one. They don't know. I mean, let's face it, they just don't know. A recession that I've always understood as an explanation of recession, I would go to Investopedia. And I've always thought a recession to be 2 negative quarters. But hell, we've changed our GDP. Who knows is not finding what I want. Recession definition. There we go. Thank you. Can barely find it. A period of temporary economic decline during which the trade and industry activity are reduced, generally defined by a fall in GDP and 2 consecutive quarters. That's what it used to mean, right? That's what a recession has always been for me since high school. Since high school, that was what a recession means. but my hell, if we don't change it to mean whatever we want. And it's ridiculous. It's absolutely ridiculous that we can't figure it out, that we're acting like we're not in a recession, and people are now worried about next year being in a recession. Again, 2 weeks ago, I gave you an article. It's going to be wide but shallow. That just means we'll probably have 2 negative quarters next January through March. This Q1, Q2, August, excuse me, April through June. And then we'll kind of come back to the end of the year. It's interesting because it is hard to say market trading at 17.5 times calendar earnings as trading at a true value given the economic writing on the wall and has the intent of raising rates and knowing that company has yet to issue forward 2023 earnings guidance. So we've been in a recession. We might get out of recession because we've never been in a recession the last quarter since, I don't know, 1950, some ridiculous time. But it's really, where are the market going to struggle for our GDP? And if you ask me, are we going to get a hold of gas prices? Are we going to be able to, take care of it or not? All right. Anyway, so that's just a piece of my mind. Costco is really something to look forward to for earnings. We finish off with AutoZone, Toll Brothers, GameStop I watch, as well as Sportsman's Warehouse, Lululemon, Vail, DocuSign, Broadcom. Economic reports, really pretty tame this week. We do have PPI or inflation numbers on Friday. That could juice us Friday if inflation is not growing as much as we think. All right. Interesting article on who will be Disney's next CEO. Here are the top picks. The top 2 candidates right now are women, and I really enjoy one of them. If I could have my pick, I would have put her in before Chapek. She seemed to be someone that I thought was really good, and that's Dana Walden. Dana Walden would be my vote on who the next CEO would be. Until they get through their woke issues, though, they will lose a lot of the conservative people that still use their stuff. I'll tell you, I much rather like Disney products, movies, and so forth, maybe as much as 5-6 years ago than I do now. I've got a BlackRock unit that says time for new portfolio playbook, reveals how to position. Again, shocking. Work your cash, buy bonds, reallocate away from growth stocks. Obviously, they haven't done or looked at a chart to see how well growth stocks has performed the last 2 months. Oh, just live with inflation. Here we have another Kamala Harris. Just live with inflation. Of course, things are more expensive. Again, another garbage article written by a garbage company. I'm not a big fan of BlackRock because of the cost of their funds. And obviously, they're in it for their own commissions. Top Wall Street analyst says these stocks are stocks to buy during a market downturn. I picked it up because a lot of people were in NVIDIA, Marvel, Costco, Monday.com, and Disney. Just something so you're seeing someone else's comments and some things that I noticed or agreed with. So with that said, I don't think so, Bill. And the Walmarts are not Waldens, they are Waltons with a T-O-N. Any questions you guys have that I can answer for you today? Again, we'll probably do this for this week. I think the 19th will be our last commentary. We'll miss the next 2 weeks, and then we'll come back the second full week in January. So Kevin, how do you think the night's going to the night? I just thought it, Ram. Kevin, how do you think the year is going to end? It would not surprise me to see our market down, and I'm going to check current market status. I'm pretty sure we're down 17% year to date. I'm looking. It says year to date 16.10%. If you take out the 1.22, again, we're roughly down 17%, 17 and a quarter. It would not surprise me to see us down in that 20 to 22% range, which means, thank you for mentioning that because I did not fix it, which means I would expect December to be down that 4%. And that would put us at that being down 22%. And we'll probably have a rough opening to the year next year, is why Keith and I are prepared for more protection and just doing what we can to make up as much of the downward movement as possible. Again, we're at 20%. We were as high as almost 30% in some accounts. The fact that we're so cash heavy gives us some great opportunities. We just have to put that money to work. And we're not interested in just throwing it in because we can pick up shares. We're using our technical analysis or our level 1 education to make our best educated decision. Great question there. Any other questions? So let me put that caveat in there. Ask me again Wednesday, or it'll probably be an important trade findings and adjustments Thursday, December 15th. It really does depend on what's being said with the Federal Open Market Committee. Kohler, I got your message and I will get to work on that for you. We'll call you tomorrow morning, 8 a.m. Eastern Standard Time, and I've got your number written down. Guys, have a wonderful evening. Pleasure talking to you, and I'll see you again next week. Bye-bye.